This is your ultimate guide to stock investing for beginners. Hi, this is Mosh and I am an amateur investor. I have gone from $700 to way over $35,000 in 1 year in the stock market. I'm going to give you everything that you need to know about stock investing and the stock market for beginners. I'm going to tell you guys everything that I have learned myself and use my own experience to help you guys out in the stock market, because it can be a daunting place. Let's start off with why you should be in the stock market and do stock investing. The stock market is the biggest wealth building tool to ever exist. As long as you have internet and a little money to start off with, you can make money. I'm a scientist, I always go by the data. The data is the evidence, and let's look at the evidence for the stock market. This is the last 90 years of the S&P 500, the top 500 US companies, and what the returns have been. The annual rate of return for the stock market is around 10% every year. If your bank is offering you in your savings account less than 2%, you're actually losing money. The reason why you're losing money is due to inflation. So your bank is literally stealing money from you without you knowing. Inflation is roughly around 2% every year, and I like to use the Freddo indicator. So if you're in the UK, you know what a Freddo bar is. It's a very small chocolate bar that you probably remember as a kid. This is how the price of a Freddo has changed. Back in the early 2000s when I was at school, it was 10p. Now the cost of a Freddo bar, considering the size of the bar has not changed, is 29p. That is due to inflation. Not just inflation of the chocolate, inflation of everything. The ingredients, the labor cost, the transport costs. They have to make profits on top of that as well. So the prediction is by 2030, the Freddo bar will cost around 38p. So inflation is eating away at your personal wealth if it's left in a bank account or hidden under a mattress. Whereas the stock market gives an annual return of 10%. If we take out inflation, it's around 7%. You can also become a millionaire by investing in the right companies. In the year 2000, the Amazon stock was $62. Currently, it's at $3,500. That means if you were to invest $10,000 in the early 2000s into Amazon, you would have made just over $500,000 right now. If you were to invest $20,000 in Amazon in the early 2000s, you would be a millionaire. This recently happened with Tesla, and they're called Teslaionaires. Basically become millionaires by investing in the Tesla stock just over 10 years ago. So what is a stock market? The stock market is where you buy and sell stocks. A stock is a share of a public company. Therefore, you become a shareholder. If the company does well and makes profits, you get dividends, which I'll talk about later in the video, so keep watching to the end. Or you sell to someone else that is willing to pay more than you paid for that same stock. Everything I'm going to talk about this video is for beginners. You don't have to be a genius to be in the stock market or do stock investing. You can even give your money to a fund manager and they'll do all the work for you, and you'll still get those returns of annual 10%. Now that you know what a stock is, it's time to look at the different types of stocks. The first thing, all stocks are categorized in sectors. For example, you have the technology sector. In there, you'd find stocks like Microsoft and Apple. You have the financials, so they're like your big banks like JP Morgan, HSBC. You have your consumer defensive, things like Walmart. You've got healthcare, which are companies like AstraZeneca, and you have a few other categories on top of that as well. Now, once you found an interest in a sector, you can look at individual stocks. They're categorized like this. You have the growth stocks. So these are investors that are looking for high returns. These are the riskiest of them all. The reason is these are long-term holds and these are unproven companies. So for example, Amazon in the early 2000s was considered a growth stock because it was an unproven company. Me, myself, I invested in Neo last year at $4. Now it's worth over $40. So I've made over 1,000% return on that company. However, not all of these companies work out. There's many that fail. That's why it's the riskiest of them all. Next is income stocks. These are companies that pay dividends. Now, to pay dividends, the company generally has to be making profits, and if they're making profits, they're generally low risk. For example, AT&T is a big telecoms giant. They used to give out a dividend of 7%. Now it's going to reduce around 4%, which is still a very good dividend. Next, you have the blue chips. These companies have low debt, they're very large companies, and they pay regular dividends. Examples of these will be Unilever or a company like Visa. Next, you have defensive stocks. These are stocks that are not really affected by economic activity. A classic example is Coca-Cola. Lastly, you have the cyclical stocks. They are greatly affected by economic activities. A classic example is the banks. So if the economy does well, the banks do well. If the economy is not great, the banks, they go downhill. Lastly is the meme and penny stocks. If you're a beginner investor, avoid these at all costs. It is just gambling. Next, you have to figure out what type of investor you are. There's 3 types: active investor, passive investor, and retirement investor. I'm going to break down all 3 categories, so that should help you determine what type you are. Firstly, how to become an active investor. This is me. This is what I do. Active investors are always reading financial news, researching into companies that they don't know about, and using risk management strategies. The reason why I'm an active investor because it makes you the most money. However, it's the riskiest type of them all. Plus, you have to invest a lot of time and effort by reading financial news, researching companies, and it's quite taxing on your mental health as well if you're not used to taking losses. If you're choosing this route, I would recommend that you use any spare cash that you have and you clear off all your personal debts first before becoming this type of investor. The next one is how to become a passive investor. If you're watching a beginner's guide to stock investing, you are probably going to be a passive investor. Now, passive investors are not aiming to get massive gains. An active investor, for me, I try and get 20% gains every week, which is very difficult to do. A passive investor is happy to get 10 to 20% gains in a whole year. You don't have to listen and read financial news every day. You don't have to deal with the daily stress of the stock market, especially if you have a full-time job and a busy family life. A passive investor generally buys a few individual stocks, index funds, which I'm going to explain later, stocks for dividends, or gives the money to a fund manager. Or it could be a mix of all of those. A retirement investor is a passive investor. However, as a retirement investor, so you're close to retirement, what they tend to do is they will reduce their stock portfolio to around 50%, and the rest of that 50% goes into bonds. Bonds are basically government debt and they pay you interest. That is for another video, because it is a massive market. So what are dividends? They are profits the company has generated that it shares with its shareholders. So if you have a stock of a company that makes profits and gives out dividends, you'll receive some sort of income from that. The key metric to look out for is the dividend yield. That will tell you how much you will get. The way that's worked out is the dividend over the stock price. The dividend is the amount the company is going to give you per 1 share over the stock price at that current time. So if a company is offering 5% dividend yield and you had $10,000 invested in that company, annually you would make $500 just by being a shareholder. One thing to also bear in mind, which a lot of people overlook, is as the stock price goes down, the dividend yield increases, and as the stock price goes up, the dividend yield decreases. So how do you find the best dividend paying companies? The first category you want to look at is the dividend aristocrats. They are companies found in the S&P 500, so the top 500 US companies, and they have been paying dividends and increasing it every year for at least 25 years. So companies like Walgreens, Caterpillar, 3M, they are your dividend aristocrats. However, there is an even better category. It's called the dividend kings. They have been paying dividends and increasing it annually for at least 50 years. Imagine that. The reason why they're a separate category is because not all these companies are found in the S&P 500. The biggest benefit of dividends is you get a stable income. Plus it means the company has strong financials. So that means they generally have low debt, they're making profits, and they're sharing those profits with the shareholders. And a lot of companies pay quarterly, some pay monthly, like for example, realty income, and some just pay yearly. The disadvantage with these companies, they're slow movers. So the stock price doesn't really go up much or down much. It generally remains quite stable in line with the S&P 500. One thing from my personal experience I found out is you need to have a lot of money invested. For example, if a company is offering a 5% dividend yield, which is very healthy, which is a very good dividend yield, you have to have $600,000 invested to get an annual income of $30,000. For me, I want to get a point in my life where obviously I can invest $600,000 and get an annual income of $30,000. Next, we're going to look at is what is an index fund and how to invest in an index fund. An index fund is basically a portfolio of stocks. So many companies all categorized into one index. And an index fund tries to replicate the index. The US has 4 main ones. It has the S&P 500. S&P stands for Standards & Poor. index, which is basically the top 500 companies in the US. You have the Dow Jones. The Dow Jones is the top 30 US companies. You have the NASDAQ, which is your biggest tech stocks, and you have the Russell 2000, basically your small companies. The UK has two main ones, the FTSE 100, the top 100 companies in the UK, and the FTSE 250, the top 250 companies in the UK. Japan has a main one, the Nikkei 225, the top 225 companies in Japan. Every country has an index. The two biggest fund managers are BlackRock and Vanguard. Vanguard is probably the most famous one. So if you want to buy into the top 500 companies in the US, you can buy the Vanguard S&P 500. And this is known as an ETF, an exchange traded fund. So when you buy one share of Vanguard's ETF for the S&P 500, you are basically buying into the top 500 companies in the US. And Vanguard has funds all around the world in different countries. So it's not just for the S&P 500. The reason why Vanguard is so popular because it has a very low fee of just 0.07%. So if you invested $10,000 into the Vanguard S&P 500, they will charge you annually $7 to manage that fund. So you're doing zero work. They will do everything for you. When companies come in and out of the S&P 500, they will automatically do that change. You have to worry about nothing. As we know, the S&P 500 has an annualized return of 10%. This is where the power of compounding comes in. So watch this. If you're to start off with $500, okay, and we have an annual interest rate of 10%, because the data shows the annualized return for the S&P 500 is 10% for the last 90 years. So that is a lot of data that you have. Let's say for 25 years. Now, let's say every month you put in $500 into the Vanguard Index Fund S&P 500. Watch this. You started with $500 and every month you're putting in $500. After 25 years, your final investment will be worth around $670,000 and you would have made just over $500,000. And you can literally look at this and break it down year by year. The key thing to remember is when you put the $500 in every month, you are not taking any money out. When you get dividends, you're reinvesting those dividends. And at the end of 25 years, you can very comfortably retire on that. That is a art of compounding. Now, let's say we keep our initial investment of $500 and we bump it up to $1,000 a month for 25 years. Watch this. You become a millionaire. Your final investment will be worth $1.3 million and you would have made just over $1 million just by investing $1,000 in a month into the S&P 500 for 25 years. Next, I'm going to talk about which brokers you use and which are the best. In the last 5 years, it has all been about commission-free trading. Before, people were paying for every single trade. The biggest ones in the US that I know about are Robinhood and eToro because they are commission-free. So you've got a lot of amateur traders like myself that have managed to get into the investing world and into the stock market. In the UK, the best ones are Trading 212 and Free Trade because they are commission-free. So if we have a quick look at Trading 212, it says on the website, commission-free investing for everyone. It's the #1 trading investing app, which I'll probably agree with. It is very good. I use it myself. Okay, and as you can see, for each different market, it's all commission-free. Every trade that you do, you pay 0 commission. However, this is where you need to be careful. Trading 212 does have a hidden fee. The first one is a spread, the difference between the buying and the selling price. There'll always be a difference. It could be a matter of pennies or it could be a bit more, depends on how volatile that stock is. The next thing you have to watch out for is the foreign exchange fee on Trading 212. It's at 0.15% and I'm a bit surprised they don't advertise it here. So if you're buying into US stocks, you are paying 0.15% of that total amount as a foreign exchange fee. The next one, let's look at Free Trade. Again, it's commission free and again, it's one that I use myself. I recommend to have at least 2 brokers. You can see buying and selling is all commission free. You can buy fractional shares, so you don't even have to buy a whole share of companies. You can buy like 0.1 of a share and build up to a full share. You can do the same on Trading 212. Now, it does have a slightly higher foreign exchange fee, but they do advertise it It's at 0.45%. It's still relatively low, and if you're a passive investor, it doesn't really matter over the long term. If you're an active investor, then that does add up. The best thing of all is you can get a free share worth up to £100 of Trading2 on a free trade using my link below. All you have to do is open up an account, deposit £1, and they'll give you an absolutely free share. The only benefit I get is I get a free share too. Now, both Trading2 on 2 and Free Trade also have an ISA. An ISA stands for Individual Savings Account. Your annual allowance in the UK for this tax year is £20,000. So what does this mean? Let's say I used up my whole allowance, I invested in one company and I put in £20,000 into my ISA account. That means I can't add any more money into that account. Let's say after 6 months, that investment went up to £100,000. I can sell that investment, making a profit of £80,000 completely tax-free. No capital gains tax, no income tax, nothing. Because it was in the ISA account. Just be aware you're only allowed one ISA account per tax year. So you will have to choose between Trading2 on 2 or Free Trade. Now, if you're completely new and you're very uncomfortable with the stock market, you can actually use a fund manager. You give your money to a fund manager, they will do all the investments for you, buying, selling, rebalancing, investing in index funds, ETFs, and all they'll do is they'll charge a fee. Now, I started with a company called Invest Engine, and I started in March 2021, and I am up just over 4%, and that's doing zero work. All I literally did was put money in, never looked at it again, don't look at it daily, and wait for the returns. They have a very low fee of 0.25%. That is it. So basically, for every £1,000 you put in, they will charge you an annual fee of £2.50 to do all the hard work for you. I've actually spoken to the company myself with the CEO and the head of marketing. They're offering you guys £50 completely free. If you open up an account using my link below, deposit a minimum of £100 into there and you'll get £50 completely free. Just bear in mind, you have to leave the money in there a minimum of 12 months. Otherwise, you have to give that £50 bonus back to them. How to find winning stocks. Focus on what you know first. There are 1,000 stocks out there. So for example, if you work for Ford and you're an employee of Ford and you know they're developing exciting cars, that should probably be your first investment. If you know the company is going to make these amazing cars and it's going to do well. If you work in the airlines and you can see the airlines are recovering, you've been called in for more and more flights, then that should be an indicator that the airline stocks will recover. So that is your first starting point. Stick to what you know. Do not listen to FOMO. In my early days of investing, I have been guilty of this. The cannabis stocks, the penny stocks, the meme stocks. FOMO means fear of missing out. Always do your own research. I use apps like investing.com, Yahoo Finance, Simply Wall Street. They are my go-to apps for research. If you want to do more advanced level research, I use a website completely free called FinViz. I've done a whole video on this. I'll link it up at the top. Keep up to date with news. So use things like Yahoo Finance, CNBC, Seeking Alpha. You can actually buy and sell on good and bad news, and that can make you a lot of money. I've said this before, avoid meme and penny stocks. So things like AMC and GameStop, everyone heard about what happened to them. Yes, you can make a lot of money, but you can lose a lot of money. Meme stocks are pretty much just like gambling. No one knows what's going to happen. Next up is investment strategies. The first type of investment strategy is called fundamental analysis. So this is more for long-term holding and long-term stocks. One of the greatest fundamental analysis is Warren Buffett. He is the OG. This is really about the business finances. So you're looking at the financial statement, the income statement, the balance sheet, figuring out how much profit they have, how much debt they have, what are they doing with the money? Are they reinvesting it into the company? Are they making new products? So you're looking into all that detail. The aim of doing fundamental analysis is to buy undervalued companies. Now, this does take a lot of effort and you have to get good at reading financial statements. Next up is technical analysis. So this is where you're analyzing graphs of stocks and you're using certain indicators or a couple of indicators to figure out what's going to happen next. This is mainly looking at the supply and demand of shares and the general momentum of the stock. Technical analysis is mainly used by day traders or active investors. So I use it a lot. I actually use a mixture of both fundamental and technical analysis when I'm investing into companies. The third type of investment strategy is sentiment analysis. This is basically based on human psychology because the market does what the market does. No one can ever be 100% sure, even your big investors can never be 100% sure what is going to happen. For example, the 2008 financial crisis, the stock market went down around 34%, but the following year made a recovery of 24%. How crazy is that? Just last year during the pandemic, there was a massive dip and the recovery was crazy. It recovered so quickly and no one expected that. Generally, optimism. So for example, during the pandemic, finding a vaccine and the vaccine rollout was pretty quick. So that led to optimism in the economy, therefore optimism in the stock market. So we call that a bull market. The stock market's going up. Now, a bear market is when something major happens, like a trade war, pandemic, a world war, something that shocks the market that leads to a major sell-off. So the overall value of the stock market is declining. I think another one that people overlook is market behavior. So for example, there's been a general shift away from fossil fuels into renewable energies. And that's not just from companies, that's from consumers as well. For example, more and more people are buying electric vehicles. That's why Tesla has done a massive run up. NIO, XPEV, all these electric car makers have done a massive run up because that's where consumer sentiment is heading. And the market has to follow wherever the consumers are going because that's where the money is. Always follow the money. The single best investment strategy, and this is generally for passive investors, is buy, hold, and keep buying. So there's something called dollar cost averaging. The market is always moving up and down. If you're putting in $500 every single month into an index fund or into a certain stock, what would happen eventually is you will even out. So there wouldn't be a massive loss or a massive gain because time in the market is extremely hard. If you're very bullish on a stock, so let's say you want to buy Amazon and hold it for long term, sell it 20 years down the line because you think it's going to be worth a lot more. You can buy Amazon every single month. A better strategy would be to buy a large amount on a dip. So when Amazon dips, you're putting in, instead of just buying $500 every month, you're putting $1,000 or $2,000 every time it dips and keep buying the dips. From my own personal experience, buy and hold always wins if it's in good value stocks or a good index fund. You won't get crazy returns, but you definitely get the annualized returns of roughly around 10% every year. As an amateur investor, having made the most money I've ever made in my life in 1 year, this is my golden gems. This is what I have learned. Sell your losers for small losses before it becomes bigger losses. I use something called stop losses to stop this happening. Most apps like Trading 212 and Free Trade will have this, where you can determine a certain amount that your stock gets to before it automatically sells. So let's say you bought a stock for $50. You're hoping to sell out at $60. However, the stock goes to $45. You can put a stop loss at $45. So from $50, if it goes to $45, it will automatically sell that stock. So you made a small loss rather than a big loss, because it can keep going further down. This will mainly apply if you're an active investor rather than a passive investor. Always hold the stocks you 100% believe in. You've done your research, you know it's going to do well. Do not sell, even if it starts going down. I've made this mistake many times. Another thing that I've learned is let your winners run. Do not take profits too early. Again, I've made that same mistake many times. This is a key one. What would happen if you were to lose it all? Is it going to change your lifestyle or massively affect your financial situation? For me, if I was to lose it all, I'd be annoyed, a little bit upset, but it wouldn't change my lifestyle. I could carry on paying my mortgage, paying my bills, paying for my car, paying for holidays, having my normal life. If it's going to affect your lifestyle massively, then you're in too deep. You have too much invested. Last thing I'll leave you is great books to read about the stock market and stock investing if you're a beginner. I'll put the Amazon links down in below if you want to buy these books. The first one is The Simple Path to Wealth by J.J. Collins. It's one of my favorite books. This will make you understand the power of compounding and change your psychology about what money means to you. In this book, he talks about index funds and compounding a lot, and he relates to his own personal experience of how he managed to become financially free. A great book. Next one, I recommend Trading in the Zone. Psychology plays a big part to investing, especially if you're an active investor. This book tells you how to really get that discipline to being a stock investor and understanding the psychology around it, and it increased your confidence being a stock investor. The ultimate classic, The Intelligent Investor. This is basically the Bible of stock investors. This is all about value investing. So if you're a passive investor, retirement investor, this is a book for you. It gives you an A to Z of how to find value stocks. Lastly, One Up on Wall Street. Again, I really like this book because this is more about how to find those hidden gems of stocks, the growth stocks. For me, it was NEO and XBEV. For people in the 2000s, it was Amazon and companies like Apple. So he's talking about actually to be a stock investor, you already know a lot about the stock market because you're a consumer. You're always buying goods. And based on that knowledge, you actually have an upper hand compared to people on Wall Street because you can find those hidden gems in shops and based on your own activities. I hope you enjoyed this beginner's guide to stock investing. If you learned at least something, I would appreciate a like and a sub on this channel.